So Santander have just launched what they like to call My First Mortgage, and this is to help more first-time buyers access the market. It's a mortgage product that offers 98% loan to value, a 5-year fixed rate at 5.19%, and that's with no product fee and a £250 cashback. And lending's available between 190k and 500k, with a maximum term of 40 years. But here's the issue. Whilst it says it's a 98% product, there's a minimum deposit of £10,000. So yes, it is a 98% loan-to-value product, but only if you're buying a £500,000 house. So let's quickly run through it, starting with who can actually apply. It's first-time buyers only. And for joint applicants, both of you need to be first-time buyers. There are property restrictions as well. The 98% loan-to-value is only there for existing houses. So flats and new builds, 95% loan-to-value. No self-employed applicants. So this is only for PAYE employed borrowers. And the affordability is a maximum loan to income of 4.45 times. And of course, you still obviously need to pass all of Santander's affordability and credit checks, etc. So yes, it is technically a low deposit product. A 2% deposit with a minimum £10,000, lower than many traditional mortgages. And from that perspective, it does make home ownership that bit more achievable. And of course, the 5-year fixed rate does offer good predictable payments and a bit of certainty. Cashback and no fee. £250 is going to help out, but it's not going to go a long way when you move into your new home. But with no upfront product fees as well, it doesn't make it a bad choice. And one of the nice things about this is that there's gifted deposits and multiple applicants. So Santander allows family members to gift the deposit, and on other products they allow up to 4 applicants, which can help boost affordability. But as we've said before, the self-employed are excluded. So any self-employed buyers can't use this scheme. They've got to look elsewhere. And it's restricted to only existing houses, so no good for new builds, no good for flats. And you've also got the risks that are attached to having a higher loan-to-value. At 98% loan-to-value, there is an increased risk of negative equity. Because when you first sign up to this, you only own 2% of the home. It doesn't take a major regional house price fall to put you into a negative equity situation, certainly for the first year or two. And of course, starting off with that higher loan to value, you've also got the risk that when you do come to the end of your 5 years, you're still going to have quite a high loan to value, which means you're not going to be able to access the better rates that are out there in the market. So is it right for you? Well, it's going to suit certain borrowers. Employed first-time buyers, if they've got that stable income, they want that 5-year commitment, and they're looking at probably higher priced houses. New builds and flats are excluded, and there is that minimum on it of 190k. So I really do see this product being used a lot more down in the south than here in the Midlands or further north. And of course, if you've not got that £10,000 deposit, then there's other options around. You've got things like the Skipton Building Society's Track Record Mortgage. That was launched back in 2023. And this is there to help people who are already renting, who have got a proven history of paying rent. And it's effectively a 100% mortgage, meaning no deposit required, although Skipton will accept a deposit of up to 5% with this product. Eligibility-wise, you've got to be over 21, you've got to have not owned a property in the last 3 years, and you've got to prove that you've been paying rent for at least 12 months consecutively, and that you've got no missed debt or credit payments in the last 6 months. The loan can be up to £600,000, and they accept new builds and flats. And this is England, Wales and Scotland, but not Northern Ireland. Again, it's a fixed rate for 5 years, and there's no completion fee on it. One thing they will want to see, though, is a letter from your letting agent confirming those rent payments. So this is no deposit whatsoever needed. New builds are eligible, and there's no fees. On the downside is the strict rent history. You've got to be able to show that unbroken record of rent and bill payments. Skipton's standard affordability tests still apply, and the maximum age at end of term is 75. And again, as with Santander's product, there is a serious risk of negative equity. If you're borrowing at 100% loan to value, even a slight change in house prices downwards is going to put you into negative equity. And then there's the Yorkshire Building Society and Accord Mortgages. They do 5k deposit mortgages. So this is very similar to the Santander product, but 5k instead of 10. These were launched back in 2024, and they allow first-time buyers to borrow up to 99% of the property value with just £5,000 as a deposit. Eligibility-wise, first-time buyers only, but only one applicant actually has to be a first-time buyer. But neither of you can own a property. Both applicants must be under 70 at the end of the term of the mortgage. Maximum property value is 500k, and it's not available for new builds or flats, and not available in Northern Ireland. Rates-wise, it's a bit higher than Santander. It starts from around 5.35%, up to about 5.58 for Accord. But you've got lower savings needed, so it's 5k deposit instead of 10k with Santander, and you can borrow up to 99%. On the downside, obviously you've got those higher rates. It's slightly more expensive than Santander's offering. There's property restrictions, and the availability is limited. And then, of course, let's not forget April mortgages, the no deposit mortgage. This one was introduced in May 2025 to an absolute fanfare. This is a 100% loan-to-value mortgage targeting renters and movers. And unlike some of the guarantor schemes, this mortgage assesses borrowers based on income and credit alone, no guarantor required. So it's no deposit needed. You can borrow the entire property value. There's long fixed terms available, so you can actually fix this product for 10 to 15 year fixed terms, with interest rates starting around 5.99%. So it is quite an expensive product, but it does give you certainty. And there's also a 5-year option for some applicants. So the interesting part of this is that you get automatic rate reductions. We've talked before about the various bands at which loan to value really matters for getting rate drops. And with this product, as you hit each of those bands, your rate automatically drops as you repay and your loan to value improves. And flexibility wise, there's no early repayment charges. So you can make unlimited overpayments on this mortgage. Although it starts off quite expensive, it could be a really good option for the right person. Income wise, you're typically going to need a household income of at least 24,000, and the property itself must be worth more than 75,000. Credit wise, applicants need a clean credit record and at least 12 months of on-time rent payments. So you've got that zero deposit, which is ideal for renters with no savings, but you can afford the monthly payments. Rate reductions are built in, so as you pay down the loan, your rate automatically decreases. And there's no early repayment charge, so flexibility for overpaying. But on the downside, you've got that higher interest rate that starts out at 5.99% currently, and it's a long-term commitment, so you're fixing for 10 to 15 years. And this could be restrictive if your circumstances change. And as with all of these high LTV products, you've got that risk of negative equity. Once again, borrowing 100% means even the tiniest change to house prices is going to affect you. So buyers with good incomes, strong credit, but who are struggling to save a deposit because of rent, this could be an option. And of course, we can't finish this off without talking about Generation Home, Gen H. They take a bit of a different approach, which allows family and friends to directly help with deposit and income support. A deposit booster contributes to your deposit via either a loan or equity stake. They basically gift money, lending it interest-free, or take an equity share that grows or shrinks with the property value. The arrangement has to be documented and a bespoke agreement's drawn up, and the repayments are managed by Gen H. But interestingly, booster funds can come from non-UK residents, but they must be held in a UK account for at least 3 months before being introduced. And multiple boosters are allowed, but every one of them has to take independent legal advice. So this is a way of formalising family help that protects all parties, and boosters can choose how they want to be repaid. It does require additional legal advice, which does cost money. And of course, anybody helping out and taking an equity stake in the property is going to be exposed to that property's value should it go up or down. So an income booster, which is usually a family member, goes on your mortgage to increase your affordability. Their income is considered for borrowing, but they're not on the title deeds, and that preserves the first-time buyer stamp duty status. And Gen H will assess if you can afford the loan on your own in the future. And if so, then the person providing the boost can be removed at remortgage time. And there is also an option for boosters to contribute to the monthly payments and actually build up an equity share in the property. So this is a great way to help first-time buyers borrow more without losing all those first-time buyer perks. And there's a flexible exit route for those that want to help. On the downside, anybody helping out as a booster can be liable for the mortgage and must take legal advice, as they could be exposed to a credit risk if you were to default on the mortgage. And then, of course, there's also the New Build Boost. This is another innovative product from Gen H. The New Build Boost targets buyers of new build properties, which many lenders restrict. You bring at least a 5% deposit. Gen H provides you with an 80% mortgage, and then the builder can offer a 15% interest-free equity loan. And this equity loan is frozen, no interest or value change, for 5 years, and then moves with the property's value, capped at 2 times the original amount. This was originally launched with Permisson Homes, and is currently available on new build developments across the country. Again, it's there to help buyers with small deposits that are looking at new build homes, but it does mean part of the equity value of your home goes to the builder. And if property prices soar, you could wind up owing more money, but it is capped at 2 times. Now, one thing you'll have heard me mention several times in this video already is negative equity. When you're only putting a small deposit in, this is a real risk. And it basically means that your mortgage balance exceeds the value of your property. Santander sticks a big warning on this. Only putting in that 2% does mean you are particularly exposed to negative equity should property prices fall. And the higher the loan to value goes, the higher the risk of it happening. So how do you mitigate the risks? First of all, ensure affordability. Don't stretch to the maximum loan you're offered. Plan for potential price rises and even life events. Consider your future plans. High loan to value mortgages often come with long fixed terms, 5 years or more, or high early repayment charges. Make sure you're comfortable with that 5 years. Are you thinking of having kids? Are you going to want to move again? The 100% product from April Mortgages is great, but that's a 10 to 15 year commitment. You need to think very carefully about that. And then you can overpay if possible. If your mortgage allows overpayments without penalty, then overpaying and reducing your balance can help you build equity faster and get you away from the risk of negative equity. And of course, as you progress through time and you come up towards your remortgage, monitor property values. If you're getting close to a lower LTV banding like 90%, then dropping a bit of extra cash in before you remortgage or at remortgage could actually secure you a lower rate. And of course, you could always look at other ways of doing it. There's shared ownership, first home schemes, or you could just keep saving and keep going to that 5 or 10% deposit, which would give you more choice and lower rates. Just remember, whilst these high LTV products may open doors, they're not always the best choice. So seek professional, personalised advice. And these high LTV products and low deposit mortgages have evolved rapidly in the market. We've just seen the new 98% product from Santander. April Mortgages 100% long-term loans. There's more routes to home ownership in the market than ever before. And these products are especially valuable to first-time buyers in a market where it is so hard for first-time buyers to actually save deposits and get on the ladder. But make sure you talk to a broker. You need to know your eligibility. Lenders vary. A good broker will know exactly which scheme to look at for you. Understand the risks. As I've said before, these high LTV loans carry significant risk of negative equity. And fixing for long terms can lock you in place, restrict your options, and cause problems later on if your circumstances change. So think about those alternatives. Saving for a large deposit, government or shared ownership schemes, these could be better options for you. So with everything we've looked at today, the best thing I can say is seek advice and plan ahead. Talking to a broker early on in the process is probably one of the best things you can do, especially if you want to map out a plan to get you into that first home. I'm Patrick Weightman, your local East Midlands mortgage and protection advisor, serving clients up and down the UK. Links are in the bio. Speak to you soon. Bye-bye.